Great. I'm really honored to have this opportunity to have a wonderful webinar on a subject very near and dear to my heart as an entrepreneur. And I want to welcome everybody who's listening in to what I really believe is going to be one of the most strategic, knowledge-based assets that you could incorporate into your business strategy. And that's how to understand from the very beginning of starting your company, the exit and what it means. Not just as a moment in time when the business is completed, but as a moment in time when the business is started. It's a strange phenomenon that people don't understand that a business has a beginning and, in fact, has a life, but in many cases, that life ends as an opportunity to exit the company to another organization that can take it to the next level, or to, of course, with the dream being at some point, perhaps, and it'll be explored this morning, of doing that very rare thing called an IPO. I have had multiple opportunities to exit companies, and I've in every case taken the opportunity to think about an exit from the start. The New York Angels, as a investor, is actually in the exit business, so there may be a sense of meeting our own personal expectations, but it's an aligned expectation that both the founder and investors have together. And it's a marvelous alignment because in many of the cases of some of the greatest and most successful exits, the entrepreneur chooses wisely their investors by actually asking, how can you help me grow the business? And in fact, how in the future can you potentially give me some visibility of understanding how I can exit the business? So we have Grupo Levy and Company, two wonderfully talented professionals, Claire Grupo and Church Lewis, who are going to go through some very thoughtful slides to help you begin the process of understanding this very important issue. So I'm very excited to have them start. I'm looking forward to listening in and learning a lot myself from these two extraordinary professionals, and of course later having the opportunity of hearing some great questions. So please, everybody take notes. This really is a strategic, value-added moment in time for your business. You may not have considered it, but it's a very important time. So please, go ahead.
Brian, thank you very much. To the listeners, my name is Church Lewis, and sitting here with me is my partner, Claire Grupo, an entrepreneur who started this business, this investment banking business that we run herself 22 years ago. So she shares a lot of the perspectives of the entrepreneurs on the phone right now. Just some housekeeping. As we go through, you're going to be able to hear us, but won't be able to speak. But you will be able to, if you have questions, we're going to have 10 minutes of Q&A after this presentation, and ask you to send your questions by clicking on, if you look at the top of the screen next to the telephone icon, you'll see a little cloud. If you click on the cloud, which I'm going to do now, that's a chat function, and down at the bottom you'll see a box where you can identify who's on there, and somewhere on here, not immediately seeing it, but somewhere on here there should be an icon for questions. And if you send your questions to that icon, then at the end the recipient will ask your questions. Thank you. I'm now going to get started. So what we're going to talk about today is you're starting a business. How are you thinking about how it will turn out? Second, what do you need to get there? Third, some of the realities about funding. Those of you who've started a business may thus far have received funding from friends and family. Many of you have received funding from angels, which is the group we're going to consider most closely today. And then we're going to talk about some of the realities about exits. What is an exit? What is a positive exit? What's a negative exit? And of the positive exits, what's most accessible and most probable for you? We're going to then talk about who are the buyers of young growth companies, namely companies that have received angel backing but may not have received further funding. In order to get the attention of those buyers that are going to help you and your investors make money, what can you do to optimize that potential outcome for yourself? And then finally, we're going to talk about, sort of the whole picture of planning for an early exit at the point in time when you're actually starting the business.
Good morning, everyone. This is Claire Gruppo. I'm delighted to be here this morning with Church and with all of you. As he said, I have pretty typical entrepreneur DNA, having started my first business when I was 9. I made myself president of Claire's Sparkle Diamond Mines, and all of you entrepreneurs on the phone will identify. It's just something you can't get away from, and that is one of the reasons why we do what we do. So what are entrepreneurs trying to accomplish other than working for themselves instead of others? We have a vision. Entrepreneurs have a vision that is, to some extent, unique to them. We all feel as if we have something that we want to do that is sort of deeply ingrained in our intellects and in our psyches. We feel as if it is a way to build and lead a fantastic team of people. We like to typically work collaboratively with a group of peers as opposed to work in a very hierarchical organization, which is more typical of a big company. You want to prove to yourself and to others that you can make things happen, that you can make change happen, whatever that change is. I think you also feel as if you want to leverage your education, your knowledge. You want to, today more than ever, leverage technology more quickly than you can by working for someone else. And the truth is that you are also going to have significant delayed gratification in terms of your own economic benefit. And that brings us to this particular slide, which is something that, frankly, when I started my businesses, this one in particular, I never really thought about very much what I was giving up, other than when people said to me, "What do you mean you're leaving American Express? What about your pension?" And since at the time I was only in my early 30s, I didn't really care about my pension. In fact, I didn't even really think about what it was. So we don't think about those things typically, but there is, a fairly significant economic sacrifice to being an entrepreneur, as those of you on the phone can attest to. So we decided to just, try to quantify that. Because as you're thinking about starting your business, building your business, and then ultimately exiting your business, and what the exit means is a return on your investment and your funder's investment. And for you, the entrepreneur, it's, the sweat equity as well as, the sort of delayed economic benefit. So just take a look at this. I think it's really, really interesting. When you start a business, and, this is a kind of, prototypical example. There is no typical, but just for illustration purposes, we just took a look at, your after-tax cash as an entrepreneur starting a business. versus what you might get over a 5-year period if you stayed in your quote-unquote, say, corporate job or your salaried job. You're going to work at least a year as an entrepreneur starting a business for essentially nothing. In fact, you're probably not only getting nothing as a salary, but you are also investing your own capital and that of your, close friends and family. In year 2, we're making the assumption that you achieve some funding, and we'll talk a little bit more about the timing of that later, and some funding, which would be a seed/angel round. You'll be able to take a, modest salary, perhaps. So we just pegged it at, kind of an after-tax $85,000 over the course of a few years. You're not going to get, standard increases that you would get in your corporate salaried job. And so when you're thinking personally about building the business and your personal economic exit, you need to think about what you have to achieve, in year 5 at a sale of your business. And again, this timeline is sort of theoretical, but it gives us a good starting point. And what you need to achieve, to feel as if, this is after all not, nonprofits that we're starting. These are for-profit businesses, and where you need to get to. Over the course of that same 5-year period, you would have earned, working in a big company or, any kind of corporate salary position, a fairly significant after-tax dollar. So your year 5 exit has to be significant, not just for your investors, but significant for you. So you need to think about this early. Not only are you in business to get a return for your investors, but you need a return for yourself. And you need to think about where you want to be in that theoretical 5-year, exit time frame, so that the payout to you is worth the sacrifice and worth, the delayed gratification, certainly from an economic perspective. So we're just saying, does it need to be, less than $1 million? Does it need to be 5? Does it need to be 10? Does it need to be 20? Or does it need to be more than 20? And as you think about this for yourself, you need to think about how you can achieve your goal and how much outside investment capital you are going to need to get there. And this is an important thought process for you guys as entrepreneurs as you think about, the time frame of an exit for your business. And, like everything in life, this is sort of a bell curve. There's the probabilities of a sort of okay outcome, the probabilities of a fantastic outcome, and the probabilities of a failure. And, obviously one is on the right side, one is on the left side, but most of the outcomes are in the center of the bell curve. And you need to understand that you will own, and I'm sure most of you know this, but I think it's worth just pointing out, that, the entrepreneur is likely to own, sort of maybe as much as 30% of the business if there is no follow-on VC investment after your own seed and perhaps angel round, friends and family seed and then angel. You still retain 30% of the business. Once venture funding comes into the picture, you are going to be diluted down to somewhere in the neighborhood of 15% of the business. And so as you think about the economics for yourself and your investors, you need to keep that in mind. So here's kind of a simple, payout chart that demonstrates that if you bring in venture capital after your angel round, the sale price on the exit for your company has to be 2 times or more for you to receive the same payout for your years of effort.
So what do you need to get to a successful exit? Most importantly, issues that are internal to the company and how it operates. You need great people. The entrepreneurs on the phone have built great teams. You have confidence in the people around you. and you need good advisors. And one of the advantages of angel funding is that the angels are not just involved because they want to make a good return on their investment. They definitely want that. But they're also involved because most of them are ex-entrepreneurs themselves. They like entrepreneurship. They want to support entrepreneurship. They have a lot of experience building their own businesses, and they really enjoy and value the opportunity to mentor other entrepreneurs and be available to them as advisors. So, your angel investors are also available as good advisors. As Claire said, to get to a successful exit, you need some funding. Everybody understands that at the beginning of your business, you're going to lose some money. You need cash to fund that loss until you reach profitability. Now, the opportunity to reach profitability is key and should be achieved as quickly as possible, and all your advisors will tell you that. But some funding is required. The final ingredient is, of course, performance. You're not going to be a candidate to be purchased for an attractive price unless you achieve revenue growth, which I'm sure you all believe you're going to do, unless you have a profitable business model that makes sense to anybody who's looking at the company and for which there's some indications that you're actually achieving that profitable business model. And finally, execution. How crisply are you reaching your benchmarks? Does the company seem to be performing against its objectives effectively? So funding the business. We've talked about first funding, friends and family, accelerator programs may put some money into the business, which will cover your costs for a couple of months while they're assisting you in refining your business plan, how you present your business plan to others, and adding other valuable services that accelerators can provide. The next key funding event is going to be an angel round of funding, and the amount of money that could come from this is, anywhere between, in the aggregate, $500,000 or $300,000 all the way up to as much as $1.5 million, depending upon how many angels and how many angel groups, and whether there's co-investment from others that is part of that round of funding. In terms of some of the data, in 2013, 70,000 companies received angel funding from close to 300,000 angel investors. 45% of these companies receive this angel funding in the seed or startup phase. And what we mean by that I'll talk about a little bit more. But this is essentially the first angel funding into a company. So that, if you do the math, that's 32,000 companies. Now, consistent with that, 50% of all angel rounds of investment were first-time angel rounds. What does that mean? That's the first angel money into a particular company. You may receive more angel money from angel investors at a later point in time. We're really focused on that first angel money. Then subsequent funding possibilities are for the venture capital community, which are institutional investors, to put money into your company. They're typically not going to do that, as we'll see, in the startup phase. And then finally, it's worth mentioning that the Jobs Act has made it potentially more easy to reach the general accredited investor community through online solicitation and other techniques. We're not going to talk about that much today, but it's worth being aware of. Seed and startup funding. Generally, a seed or startup company is one that has been in existence for less than 18 months. Definitions are not exact, but in general, companies in this stage are refining their business plan, putting their team together, perfecting the product and service that they're providing to the market, generally have little or no revenue, revenue less than $500,000 per year. And as I said, in 2013, 32,000 companies meeting this definition received angel funding. The good news is this was a 36% increase from the number of companies that received seed or startup funding from angels in 2012. So the level of activity and the interest of angels in startups is clearly increasing. In the aggregate, more than $10 billion of funding for seed and startup companies in the United States came from angels. And this is 10 times the amount of money for companies meeting this definition that came from the venture capital community. Many people are not aware of that. That fact is confused by the fact that the venture capital community talks about early stage funding, but when they talk about early stage companies, they're really talking about companies that are 2 to 3 years old and not less than 18 months old. So how hard is it to get angel funding? It's not automatic. In 2013, 21% of companies that sought angel funding were able to get it. The multi-year average is 15%. And importantly, investment from angel groups like New York Angels that have a methodology that work together as members, that professionalize the process, is only about 10% of the total dollars invested by the angel community, but has an outsized influence in terms of professionalizing how the investment decisions are made, and in terms of having organized support and mentorship for the entrepreneurs in the communities in which they operate. Venture capital. So let's say you've received angel investing, you're hard at work, things are going well, you're 2, maybe 3 years into your business. How likely is it that you're going to get more investment dollars from the venture capital community? In 2013, there were, maybe 1,300 companies that received first-time funding from a venture capitalist, and that's what we're talking about in the scenario that I've painted. Not all of the companies that received first-time venture capital funding had received angel funding before that. So we don't know exactly what that number is, but for purposes of discussion, let's say it's 800 or 900 companies that had angel funding, then get venture capital funding. This is less than 3% of all the companies that received angel funding. So the odds of getting venture capital funding are very low. Now, the backing by an angel group like New York Angels may improve the odds of getting venture capital funding because greater discipline and scrutiny is applied by New York Angels, as an example, in making their investment decisions. But still, the odds of getting this money you have to know are low. And taking the money is not necessarily a great thing, even if you can get it, because as we've discussed, venture capital funding is going to cause further ownership dilution, further dilution of your ownership percentage as an entrepreneur, and may raise the bar inappropriately on the value of the business as you think about subsequent exit.
So let's just spend a little time talking about what is an exit. Obviously, we've kind of thrown a wet blanket on the VC option here. And, it's not because we feel negatively about it, but intuitively, as we sat down to pull some of these statistics together, we felt that, because so many businesses are funded in the early startup phase by individuals and angel groups, that we understood intuitively that the numbers that then went on to receive venture capital from institutional sort of quote-unquote early-stage investors would be small, but frankly, we were really surprised that the numbers seem to bear out that it's as low as 3%. And that's what we want to get focused on today and help you focus on is, that suggests that you really need to keep your eye on the exit for your business and not assume that you will be able to get more and more funding to grow it and over time, and that you have to prepare very early in the process for an exit. And that will allow you to have more options rather than fewer options. So what's an exit? The exit can be a positive exit, which is a realization, and that is the sale of your company or a majority of your company. And that sale, you get cash or securities in another business that are liquid. You sell your interest or the significant majority of your interest in your company. An exit is also termination, which means that it didn't work. And it's a wipeout. It's a near wipeout, that you have a complete and or total loss of the value of your ownership, through a liquidation or a bankruptcy, or the winding up of a failed business. And then there's this other sort of gray area. So you either sell your business and get a good return, your business doesn't work and it ends, and then there's this other this other result that really isn't an exit, which is that the business just kind of plods along. It can't get additional capital for growth. You're out of options. You might be doing okay, but the truth is that the result is the company kind of drifts sideways, and it results ultimately in a partial or total loss. So in order to get a positive outcome, which is a realization event, you need to either sell your company, you need to take it public in an IPO, or you need to merge it with a public company, which in effect is a sale of the business. One thing that we think entrepreneurs don't think about early on is that raising the next round of capital after your angel round is not an exit. It is not an exit for you, and it is probably not an exit for the early investors. New institutional capital coming in after angels are definitely loath to getting the entrepreneur return, and they don't love giving the money to the angel investors either. What will happen at that stage is that, you may be having a valuation floor for a subsequent exit that really can't be achieved. So more capital comes in, the valuation goes up, but you'll never be able to sell the company for that amount of money. So those are things to think about, the good, the bad, the ugly. Church, want to talk a little bit about IPOs?
Yeah, thanks, Claire. So just before I dive into this topic, I want to repeat that if any of you have questions, you can click on this chat function and either send questions to @all or @questions, which you should be able to see down here. So IPOs in the United States, this is interesting. In general, the probability and the chance of taking a company public has gone down, particularly since the bursting of the Tech 1.0 bubble back in 2000-2001. So since 2001, there have been fewer IPOs every year. There used to be over 300 IPOs a year on average between 1980 and 2000. That number now is just a little bit above 100 on average in the recent since the beginning of the 21st century. The companies that go public are bigger. So less than 20% of the companies that go public now have revenues under $50 million, which in itself is a pretty high revenue number. A smaller percentage of venture capital exits, the positive venture capital exits, are now IPOs as contrasted with sales or mergers. So it used to be about 50% IPO, 50% sale or merger for positive venture capital exits. The number is now only 15% are IPOs. The fraction of total venture capital first-round investments that result in IPO, again, the number for 2013 was about 1,300 first-round venture capital exits. Only 4% of that number in 5 years or 7 or 8 years, whatever the time frame is, can be expected to become an initial public offering. Finally, there's a longer time to exit. So while it used to be that 4 or 5 years after the venture capital investment, there might be an IPO, the average time to IPO now is over 8 years. So in conclusion on IPOs, the chances of a startup going public are very small.
They certainly get outsized press, that's for sure, but the likelihood of that being an outcome for any entrepreneur starting a business is very, very low.
So let's talk about another thing that I'm sure you're all aware of from reading the newspapers, the headlines. You're entrepreneurs, you follow this closely. We all have heard about Uber, Airbnb, and Dropbox, etc. You want to be a billion-dollar company. That sounds like a great thing. The number of billion-dollar companies or companies that have that valuation in the private market has indeed increased in 2014 to 26. But some observations about this. On average, these companies have raised $200 million of venture capital before hitting this mark. Second, this 26 companies represents an accumulation of first-round venture capital funded companies from multiple years, maybe 7 or 8 years. If you tracked exactly when each of these 26 companies first received venture capital funding, you'd be looking at a large span of years. But if you only looked at 2 years and said, what does 26 represent as a percentage of total first-round funded VC companies, it would be below 1%. It's interesting that of these 26, 5 of them, 20%, are New York-based, which is great. It's a positive thing for New York. When considered nationally, that's a nice number, but it's still only 5 companies. The final point I want to make is that these are not exits. As we discussed earlier, these are investment round valuations, and that could be a distortion of what the actual valuation that could be achieved in a realization event, whether it's a sale or going public, is. Many of you may know that Facebook had a private market valuation of $100 billion before it went public, and its IPO valuation was less than half of that. So that's an example of what I'm talking about. But the conclusion for you who are running startups is the way you should think about a billion-dollar value company is that it's a unicorn, which means that it's so rare as to be really irrelevant for exit planning. The sale of your company is the most likely exit that for you to achieve. And it's also the outcome for a positive realization event that's likely to occur earliest in the life of the company. The last survey that was done on this subject of angel-backed startups is was done in 2007. An update is in process, but let's look at the results of that study from that year. About 15% of reported exits had returns of 5 times or more. 5% were greater than 30 times. The average holding period for a highly successful 10 to 30 times exit, what do we mean by that? Meaning the valuation of the business when the angel investment was made upon sale was 10 to 30 times that valuation. And the average holding period for that outcome was about 5 years. Now, it's possible that the company could be sold sooner than that at a very attractive valuation. This is just an average. Again, we're talking about a bell curve. Things could happen sooner, they could happen later, but on average, it's 5 years. Importantly, which goes back to the point that Claire made earlier about terminations, which is also an exit. A company going out of business, all the money being lost, is also an exit. And 52%, more than half of all reported exits from this angel survey, were either a partial or total loss of investment. That means the company was either sold for less than the valuation that it had when the angel investment was made, or the company went out of business. The overall return on reported exits was 2.6 times the amount invested, but does not consider the money invested, as we discussed earlier, for which no exit has been reported. And your angel investors are going to be thinking, as they look at you, you're doing well, you're successful, I should sell this company or try to realize a sale because I have many other investments which are either not a sale candidate or which may be drifting sideways, and I don't know what the outcome's going to be.
So one piece of very good news here, and this is obviously from our perspective, is that there are buyers and there are significant numbers and sized companies that want to buy growth companies. The private M&A market is very active. They are looking for businesses that are angel funded, particularly those that are funded by angel groups and sophisticated angel groups, as opposed to just an individual or two. And we spent a little time looking at this data because, again, intuitively we thought the IPO is such a rare outcome. What happens to all these businesses? They receive funding, they receive significant angel funding, maybe in one round, maybe in 2 rounds. They may even receive venture capital funding in 1 or 2 rounds after that. What happens to them? We're going to run through we've got 8 different sectors that we tracked, and these are sectors which follow this slide that talk about the strategic acquirers. And what size companies they are buying. And these are, again, kind of institutionally funded growth companies. And the overwhelming majority of these deals are, these transaction values are under $30 million in value, or undisclosed, which means that they are essentially under 30. That's 85% of all of the exits that are all of the companies that are bought by strategic acquirers are under 30 million in value. So these acquirers, and take a look at this first slide. The sector is we're calling it Internet and Mobile Software and Services. And of those transactions, this is an unbelievably active sector, as we all know, a total of almost 4,200 transactions, and over 90% of those had values under $30 million. These companies are active. They're high-profile deals, which are their sizable deals, are few and far between. So if you take a look at Facebook, for example, total M&A transactions in this time period, 19, and you can see that the median for those transactions, was $12.5 million. Just keep this in mind. So the one here that's missing is probably Instagram. We also took a look at what we're calling application and system software. Again, of the total number of transactions, private transactions, which were quote-unquote successful realizations for angel and venture capital funded growth companies. These very large acquirers are super active. They are doing lots of deals a year, but almost 90% of the transactions that they do acquiring growth businesses are for values under $30 million. The same, data processing and outsourced services. This is a slightly less active sector than the first two that we talked about, but there are a lot of startups in this sort of data analytics and outsourced services, and you can see that, again, the significant majority, almost 90% of these exits, valued under $30 million. Media, the exact same, 90% in the media. These are active acquirers on the left. I mean, we're thinking of Facebook as a media company here. We have large media, data analytics media. These are all active acquirers, some private, some public companies. They are doing a lot of transactions. Not as many get done in the media sector every year as in some of the earlier sectors, the first sectors we talked about. But again, vast majority, over 90%. These companies are acquired for under $30 million. E-commerce and direct marketing, little less active for, all of you who have e-commerce businesses. It's just something to keep in mind. This is not a super active sector in the M&A world, unfortunately, right now. There are, however, companies that get bought. They get bought by retailers. They get bought by large e-commerce providers. And you can see here for this time period, again, over 90% of the companies acquired by these active strategic acquirers was under $30 million. You hear a lot about healthcare technology and our next sector, which is biotech. You hear a lot about it because there are some very high-profile transactions that occur here, for early-stage growth companies. They get acquired by these very large strategic acquirers in an M&A transaction. Again, almost 90% of these deals were at values under $30 million. Biotechnology and life sciences. We said, surely there are some very large transactions that occur here. Well, not so much. Again, sort of 75% of these transactions were under $30 million. And the last sector that we're going to talk about, and I know all of you, we're running through this fairly quickly just because we want to be able to get through it and answer any questions you guys have. But certainly we're available. Our contact info is at the end for anyone who wants to dig into this a little bit more. Feel free to call us or email us. But our last category, apparel and luxury goods, a lot of press about how luxury is hot. Big acquirers are interested in, kind of different sort of, internet-oriented, technology-enabled apparel and luxury goods. Well, not so much in terms of, the billion-dollar valuations. Almost all of the transactions, 80-ish% of these transactions in this sector were under $30 million.
Thanks, Claire. So that is, a picture that we wanted to share with you of where the most activity is in the M&A marketplace. the good news is that when you think of all of these transactions in the aggregate over a 5-year period, we're talking about over 12,000 sale transactions in these sectors alone, and there are sectors that we haven't touched on, but in these sectors alone, there are just thousands and thousands of these, as contrasted with an exit through an initial public offering, which number in the hundreds. So, there's a huge amount of activity, and a huge amount of activity with companies that have not received venture capital funding. What can you do as an entrepreneur? As we've discussed, obtaining venture capital, going public, or achieving $1 billion valuation are really not things that you can control. They may or may not be good if they happen, but it's not something for which you can readily control the outcome. What can you do? You can focus on your business, and you can focus on achieving operating benchmarks that will make you attractive to strategic buyers. And in our experience, here are some operating benchmarks that are thresholds that get strategic acquirers to focus. Having annual revenue of $5 million or more, maintaining an annual revenue growth rate of 30% or more, starting to achieve attractive profit margins, which may not wind up as positive net income because you're still spending on sales and marketing, but if the fundamental business model is that you have high gross profits or attractive gross profits, attractive contribution margins, that's interesting. And finally, demonstrating that you have a continuing differentiated position in your chosen market, which your growth rate of your revenue is testimony to, and that you're pulling away from competition. So if you can do those things, your company is going to be interesting to the acquisition market. And it's within your control to lead your company to a point where it is attractive and you can sell for $10 to $30 million. So as you sit today in your startup, you've received early funding, you're building your team, you're building your product and service, start thinking now about who might be the buyer of your business, because that is a good disciplined exercise in parallel while you're building your business. When you've achieved the operating thresholds that were discussed in the previous slide, talk to an investment bank for an assessment of your company's sale potential. In conclusion, I want to note that experienced angels, such as Brian Cohen, Avi Fogel, New York Angels, who were, Brian introduced us. Avi organizes these education meetups for New York Angels. Experienced angels believe that entrepreneurs who think ahead about exit, even at the point of startup, are going to do better in achieving their operating results by having in mind, what is the goal, what is the outcome, both for themselves as entrepreneurs and also for their investors. Thank you very much. We'll now turn it over for questions, and we look forward to your feedback. On the last page of this presentation, which I think will be available for a period of time, and we'll have it up here on the screen in case you want to jot our numbers down or emails. We welcome your follow-up, and look forward to talking to all of you further. Oliver?
Great. Thanks a lot, Church and Claire. The first question from the group, I think, is a good one, and it's, as these entrepreneurs are planning for the exit, and as they're raising capital from angel investors within the first 18 months of their operation, is it better to tell the angels that they're focused on growth and the company, or is it better to mentioned the exit as a specific strategy that they're targeting?
The short answer is both. I mean, I think that that's the short answer. The truth is, the crispest, most focused entrepreneurs are those who think about growth and think about their position in the market and how they're going to achieve success beyond the competition, but who are also enormously mindful of who needs to own their company. So I would say both. I think the exit, knowledge of the exit, which could change, over time, but knowledge of who the logical acquirers are for your business is smart.
Yeah, I quote Brian Cohen here in his book, what angel investors want entrepreneurs to know. He said, they were, as an example, an investor that came to them and said, we're going to exit in, 3 or 4 years. This is how we're going to do it. This is who's going to be interested in our business. Was incredibly compelling to them and readily achieved their support, both financially and in terms of their interest in the business.
Okay, thank you. Another question from the group. In the deals that you're looking at right now, do you see the M&A market for startups accelerating or decelerating?
Church, you want to answer that?
Yeah, I think the answer is that it's accelerating.
Yeah.
I mean, some of this is dependent upon the overall market environment. We're in a bull market right now, which is great for everybody. But I think maybe the corollary to that question is, if the market slows down, which deals are less likely to occur. And I think that the percentages that we walk through in these various sectors of, the huge percentage of companies that are done for either sales that are done for less than $30 million or undisclosed amounts, those kind of sales are kind of the bread and butter of strategic acquirers.
Right.
And that is going to continue even with market fluctuations. So that's how these strategics add, core competencies and capabilities to what they're doing. And I think that one can trust that level of activity is going to continue.
I would agree.
Okay, another question from the group. What would an angel exit look like if the company's founder's long-term plan is not to sell?
I'm not sure how to answer that.
Yeah. If the founder is opposed to selling the business ever, said that to the angel community, my guess is the angel community would not be interested in investing in that company.
I think that's right. And certainly venture capitalists would not. So even if you got the angel the angel round, long-term holders, different kind of investor, family office perhaps, long-term. People invest their capital to get a return. That's what this is about.
Okay. Another question. In the IPO slide that you talked about, some very interesting statistics, the question is, does this hold across all the sectors? This person was specifically wondering about biotech, but is there a difference among sectors in the IPO sort of events that you talked about?
I think that there is a difference among sectors, and the individual asking that question, if we have their name, we can actually dig into that a little bit and give you a more specific response. I think there's some variability, but I wouldn't say it's a huge amount of variability. And so, I don't know offhand for biotech how those statistics work out, but we'd be happy to look into it.
Yeah, it's a good question. We didn't look at it, and I would agree with Church. I think there's probably some nuance there, in terms of sectors that are a little bit hotter for IPOs, but still the numbers in the aggregate are, small.
What are the top named angel groups that are considered to be the most reputable in the eyes of VCs in terms of scrutiny?
Well, I think there's it's a good question. I think the way I would answer that is twofold. One is there's an association that exists called the Angel Capital Association, ACA. You can go online and look it up. That is a trade association for angel groups, and it has information about who are the most active angel groups nationally. And there's also something called the HALO report, which you can look for online, which also lists the most active angel groups nationally. I think that New York Angels, as an example, is highly regarded, but there are certainly others. I would say that the most useful thing to do is to look for an angel group to support you that's local to where you are. So if you're a New York entrepreneur, look for angel groups in New York, which New York Angels is one. There are others, Harvard Angels, Golden Seeds, and others. And think about it more in terms of the chemistry with the angel members that you're meeting, and whether you think they're going to add value to you, both as an investor and as an advisor, a mentor, somebody who's been through it before.
Do you find that strategic acquirers can get caught up in hot trends like VCs can?
Yes. And I think if you see that happening and your company is in that hot trend, you ought to explore it fast. But yes, they can. They are much less likely, they're not likely to overpay, much less likely to overpay, I think. But you have to be mindful of, the dynamic in the marketplace, in the sector in which you're operating. And yes, there's a lemming theory. Remember, gaming, social gaming. That was a super hot trend. Oh my God, pop. Right?
OMG pop. Right?
Yeah.
I think we have time for maybe one more question.
Great. I think this is a good one to end on, but can you address acqui-hires and what entrepreneurs should do during business development and how they should think about that in terms of their exit prospects?
I think it's definitely a trend. I think it's been more evident in the Silicon Valley than in other places where
much more so than New York.
Where there's the kind of technology ecosystem is highly textured, robust, and companies are trying to basically get engineering teams into, very big companies like Facebook, Google are trying to get engineering teams into their companies. I think it's difficult to plan for. I think it's, but certainly having you're a technology company, having the best engineers you can have is a good thing regardless. If your engineers are good and well known, they're going to be sought out, and that's among the options that for exit that will be presented to you. And they the acqui-hire numbers are I'd say maybe I'm not sure we've done this scientifically, but probably half the time do entail prices above $10 million. I think in other instances, we're talking about exit prices of $5 million or somewhere in that vicinity. So it's not as good, likely to be as good an outcome in terms of dollars as selling the business as an operating business, but it is something to bear in mind.
Yeah, and they usually happen fairly early. So there's not typically, again, there are always outliers to anything, but typically they occur at relatively early stages in the company's development.
Well, thank you all for your time. We appreciate it. We welcome any follow-up questions. You can see our contact information on the screen, and I believe that the presentation will be available to those who are interested in it and want to look at it again through the New York Angels Meetup site. And thank you for your time.